Imagine you take a crisp $100 bill today, put it inside a glass jar, lock it up in your closet, and promise yourself you won't touch it for the next 20 years. Fast forward to the year 2046. You open the closet, crack open the jar, and pull out that exact same $100 bill. It looks the same. It feels the same. But when you walk into a grocery store or try to buy a tank of gas, you realize something terrifying. That $100 bill can only buy what $50 used to buy back in 2026. Your money didn't go anywhere. Nobody broke into your house. Nobody stole it. Yet, half of your purchasing power is just gone. What you just witnessed is the work of a silent thief called inflation. In the United States, inflation averages around 2 to 3% every single year, and sometimes even higher, as we've all felt recently at the supermarket. Inflation means the prices of goods and services go up, which means the value of your cash goes down if it's just sitting still. If you leave your hard-earned money in a standard American bank savings account, earning a miserable 0.01% interest, you aren't saving money. You are safely and guaranteed losing money every single day. So, how do you fight back? How do you protect your hard work, your time, and your future? The answer is one simple word: investing. Welcome back, everyone. Today, we are stripping away all the confusing financial jargon, the scary Wall Street charts, and the complicated math. If you live in the US and feel completely overwhelmed by the idea of the stock market, retirement accounts, or building wealth, this video is your ultimate step-by-step beginner's guide. By the end of this video, you will know exactly how money works, how to make it work for you, and how to start investing today, even if you only have $5 to spare. Before we talk about stocks or bonds, let's define what investing actually means in the simplest way possible. Right now, most of us trade our time for money. You go to work for 8 hours and your employer pays you for those 8 hours. This is active income, but your time is limited. You only have 24 hours in a day and you can't work forever. Investing is the act of buying an asset that makes money for you so that eventually you don't have to trade your time for survival. Think of your dollars as little employees. If you keep them in a traditional savings account, your employees are sleeping on the job, doing absolutely nothing. If you invest them, you are sending those little dollar employees out into the American economy to build products, open stores, and generate profits. They bring back more dollar employees to help them. To understand investing, you must understand the difference between an asset and a liability. This is where most people get trapped. A liability is something that takes money out of your pocket. Your morning Starbucks run, that brand new finance car, or the latest iPhone. An asset is something that puts money into your pocket. A piece of a company, which is a stock, a property that generates rent, or an account that pays you high interest. Rich people buy assets. Poor and middle-class people buy liabilities that they think are assets. Investing is simply shifting your mindset from being a consumer to being an owner. When you buy an iPhone, you are a consumer helping Apple make money. But when you buy a share of Apple stock, you become a tiny part owner, and now Apple is working to make you money. Albert Einstein famously called compound interest the eighth wonder of the world. He said, "He who understands it, earns it. He who doesn't, pays it." Let's look at a real-world example using two friends living in the US, Alex and Ben. Alex starts early. He is 20 years old. He decides to invest just $200 a month, which is roughly $6.50 a day, the price of a fast food meal. He does this for just 10 years until he turns 30, and then he completely stops adding money. He just lets it sit in the market. In total, Alex invested $24,000 out of his pocket. Ben procrastinates. He waits until he is 30 years old to start. But Ben wants to make up for lost time, so he invests $200 a month every single month for 35 years until he retires at age 65. In total, Ben invested $84,000 out of his pocket, way more than Alex. Assuming they both got an average historical stock market return of 10% per year, who do you think ends up with more money at age 65? Most people would guess Ben because he invested for 35 years instead of just 10. But here is the mind-blowing power of compound interest. Ben, who invested $84,000 over 35 years, retires with about $680,000. Alex, who only invested $24,000 and stopped at age 30, retires with over $1.2 million. How is this possible? Because Alex gave his money more time to compound. In the early years, your money grows slowly, but over decades, your interest starts making interest, which makes more interest. It turns into a snowball rolling down a mountain. The biggest takeaway for you right now is this: your greatest financial asset isn't how much money you make, it's how much time you give your money to grow. Now that you know why you need to invest, let's talk about where you actually put your money. The most common and accessible place is the US stock market. When you buy a stock, also called a share, you are literally buying a tiny piece of that company. If you buy one share of Amazon, you legally own a microscopic fraction of Amazon's warehouses, delivery trucks, and technology. If Amazon does well and makes a profit, the value of your share goes up, and they might even pay you a portion of their profits directly, which is called a dividend. But buying individual stocks like just Tesla or just Nvidia can be highly risky. If that specific company goes bankrupt or has a bad year, you could lose a massive chunk of your money. So, how do beginners invest safely without risking it all on one company? You buy an ETF, which stands for Exchange Traded Fund. Think of an individual stock as an apple. If you buy that apple and it turns out to be rotten, you lose your lunch. An ETF is like a giant prepackaged fruit basket that contains a few pieces of hundreds of different fruits. It has an apple, a banana, a grape, an orange, and so on. If one single grape goes bad, your whole basket is still perfectly fine because the other fruits protect you. In America, the most famous fruit basket is called the S&P 500. The S&P 500 is an index that tracks the 500 largest, most successful, and most profitable public companies in the United States. We are talking about companies you use every single day: Apple, Microsoft, Amazon, Google, Visa, Walmart, and Home Depot. When you buy an S&P 500 ETF like VOO, managed by Vanguard, or SPY, managed by State Street, you are instantly spreading your money across all 500 of these giant companies at the exact same time. Historically, over the last 100 years, the S&P 500 has returned an average of about 10% per year over long periods. You don't need to spend hours researching companies or reading boring financial sheets. You just buy the whole American economy, sit back, and let the 500 best CEOs in the world work for you. If you live and work in the United States, the US government gives you incredible legal cheat codes to grow your wealth faster. These are called tax advantage retirement accounts. The two most common are the 401k and the IRA. A 401k is an investment account offered to you through your employer. When you sign up, a small percentage of your paycheck is automatically taken out and invested into the stock market before you even see it in your bank account. But here is the absolute best part of a 401k: the employer match. Many American companies will match your contributions up to a certain percentage. For example, if you make $50,000 a year and your employer offers a 4% match, if you invest $2,000 into your 401k, your employer will put an additional $2,000 into your account out of their own pocket. That is a 100% immediate return on your money. It is literally free money. If your employer offers a match and you are not utilizing it, you are actively turning down a free cash bonus every single month. What if your job doesn't offer a 401k, or you're self-employed, or you just want to invest even more? You open an IRA, which is an individual retirement account, on your own through an investment app or website. Both 401ks and IRAs come in two different flavors: traditional and Roth. Understanding this can save you tens of thousands of dollars in taxes. Traditional is tax deferred. You invest money before taxes are taken out. This lowers your income tax bill today. However, when you retire and take the money out at age 59 and a half, you will pay normal income tax on it then. Roth means tax-free growth. You invest money after you have already paid taxes on your paycheck. Because you paid taxes upfront, your money grows completely tax-free inside the account. When you turn 59 and a half and withdraw your money, the IRS cannot touch a single penny of your profits. For beginners, especially younger investors who expect their income to grow in the future, a Roth IRA or a Roth 401k is often considered one of the most powerful wealth building tools in existence.